Thank you everyone for joining us on our webinar, Demystifying UAE Corporate Tax. So this webinar is powered by Zoho Books, a cloud-based VAT-compliant accounting software, which is done in partnership with SimplySolved. It is a business consulting and services company from the UAE. So I am Sarina Ganesh Murthy. I'm a product marketer from Zoho Books, and I'm privileged to introduce our speaker for the day today. So we have, Mr. Haroon Juma with us. So Mr. Haroon Juma is the managing partner of SimplySolved, with over 25 years of global and GCC experience in finance, tax advisory, assurance, consulting, and information technology. So through his leaderships, SimplySolved is now an FTA-approved tax agency, Zoho Books premium partner, delivering ISO 9001 and 27001 certified advisory, and they also outsourced as a trusted partner, supporting hundreds of UAE clients with HR and payroll and ERP requirements. So Mr. Haroon Juma has specific expertise in proposing practical and compliant solutions to help businesses operate efficiently in the UAE legislation. So I welcome you, Mr. Haroon Juma ji.
Welcome everyone. Once again, my name is Haroon Juma, and today we'll spend a bit more time discussing and going into we'll go through quite a detailed agenda, looking at the context and background really on corporate taxes and why it's coming to the UAE. We'll go through the overall framework and principles. Now, there are some novel and new concepts that corporate tax will bring into the UAE economy, and we'll discuss that. Some of the current insights, and we'll talk a little bit more about the implication and planning, because I think for many companies now, they're looking at the practicalities of what corporate tax will imply for them and the cycle of and the steps they'll need to go through to prepare for corporate taxes. And at the end, we'll leave questions. If you could hold those questions and put them on the chat forum, we'll consolidate those, and I can take those at the end of the session in a bit more detail. Okay, so just a little bit about us. SimplySolved was formed in 2016. We principally cover quite a lot of service areas. Tax advisory, but we principally operate as a one-stop shop to many SMEs in the market that really want advisory, outsource, support and expertise on implementing compliance and more efficient reporting. Yeah, so that's our core competency. We're a finance premier partner for Zoho Books, and of course we have a number of accreditations and certifications to support our business. Now, let's go back a little bit. Let's set the context, because the context is quite interesting. The UAE has, of course, been introducing a number of tax changes ever since 2017 from the introduction of VAT. Now, as a result of the UAE starting to bring in tax changes, they signed up to the OECD framework in 2018. The OECD BEPS framework really started back in 2015, really as a real attempt by the G20 and the OECD to prevent tax planning and exploiting gaps between different tax rules in different countries. Now, this framework initially wasn't a binding framework, it was a cooperative framework. But there has been a significant change in 2021 when the landmark Pillar 2 Global Minimum Tax Agreement was signed. and it's signed by over 140 countries. There are some notable exceptions, people like Oman, people like Qatar. But this framework sets a minimum global tax rate of 15% on multinationals above 750 million euros. And that's designed to avoid the consequence of global organizations generating revenue in one country, but moving the profit into another country and avoiding taxes. That was initially what the framework was designed to do, is to harmonize global tax rates worldwide. But in part of that, there are provisions to all the signatories to introduce corporate taxes locally within their economy. And as a result, the UAE has announced that they will introduce corporate taxes, which were in 2023, and it was initially announced early this year under a press release with a number of FAQs, just to kind of indicate and highlight what the framework may look like. Now, the UAE is seeking to try and create a framework that is easy to operate and simple to understand. So a public consultation forum was announced in April to enable companies to really start to present their thoughts and ideas and their perspectives on how the framework could evolve the most effectively and efficiently in the UAE. So this is an ongoing exercise. The consultation is still ongoing. We are expecting the formal legislation to be announced in Q4 2022, but we are not sure yet when it's going to come. It's imminent, and once it does arrive, it'll provide a lot more clarity on what the framework and the principles, the procedural law, and the technicalities will look like. But what is known is that there is an introduction date on the 1st of June 2023, and that there will be a requirement to adhere to the corporate tax framework, and to ensure that companies will be prepared and ready to submit their corporate tax returns 9 months after their financial year end. So for companies with a 31st of December closing for their financial year end, they will be able to start to submit their tax returns for corporate tax filings in 2025. Yeah, so that's the current timeline and context. It's quite interesting because the UAE is seeking very hard to really try and get feedback from the general community and ecosystem to help them really think through how the framework will actually operate. And it's probably why there's a degree of delay in the initial publication of the final legislation. Now, the other policy design is really trying to get the best practices globally under the BEPS Pillar 2 framework. It has to align to the OECD framework, but it's trying to leverage quite a number of the procedural elements and the technical elements to try and make the tax law simple. Of course, UAE is a very, very FDI intensive economy. There is a lot of companies setting up here because of the favorable tax laws, and the UAE still wants to retain itself as a preferred destination for foreign direct investment. So they want to maintain that competitive edge. However, they also realize that there is a requirement for public finance income in the coming years, and corporate tax presents that because there is some, resistance around income tax on personal income, but they still want to maintain themselves as a competitive edge. And by setting a 9% rate, this still remains a competitive rate compared to other countries worldwide. There are higher rates of corporate tax available in Europe and likely to be higher in other parts of the global community. So UAE still will remain a competitive regime at 9%. What the initial importance for I think the Ministry of Finance is to ensure that it's a simple and transparent model. It does provide clarity and ease of understanding, simplicity, and transparency. Yeah, so we hope when the final legislation comes out, it'll provide enough detail and enough ability for us to basically plan a bit more specifically around corporate tax implications. Now, there are some key corporate tax principles we already know about. They've been published within the initial consultation paper, and there are some interesting elements in here that give some benefits for UAE companies. So there are a number of highlights here, everything from the rate of 9% on income as a direct tax to a number of interesting themes we'll talk in more detail around, particularly around free zones, tax unities, uh, withholding tax provisions, and the ability to carry forward tax losses. Yeah, so there are some reliefs and exemptions, some benefits that the UAE has already thought about that they believe will create the right environment to continue its position as a leading place for FDI. Now, I'm going to go into the specifics now on the corporate tax overview. There will be probably questions that you may find you will need to ask, but please note those down, put them on the Q&A, and we can discuss those in more detail later. Now, the first thing to note on the corporate tax overview, on corporate tax, is that there are two bodies that will be involved in the administration of corporate taxes in the UAE. The first is the Ministry of Finance. The Ministry of Finance will oversee bilateral and multilateral agreements with other international parties and exchange information. So the corporate tax regime will create a framework for information exchange across all tax authorities worldwide, and the Ministry of Finance will govern that process. The administration, though, of the tax system, of the local tax collection and enforcement will fall under the hands of the Federal Tax Authority. Yeah, and you can see now there's some gearing up with the new tax system called Emira Tax towards ability to administer and manage the tax system within the UAE more effectively and more flexibly. So there is clearly now a direction to push the administration now under the FTA's auspices. So first things first to really explain the scope of corporate taxes. Now, corporate taxes will apply to legal persons incorporated and or foreign persons managed in the UAE, and introduces the concept of a permanent establishment. I'll talk a little bit more about that. So legal persons can be an individual, and these individuals, if they are conducting some commercial activity within the UAE, will fall under the auspices of corporate tax. The second place will be natural persons, so any business or commercial activity under a trade license. So legally incorporated companies, limited liability companies, and free zones are within the purview of corporate taxes. And the third category are non-resident persons carrying on a business via permanent establishment. Yeah? And permanent establishments are, we'll talk a little bit more about that, but essentially any company that is operating through an agent, a dedicated agent or a dedicated distributor creates a permanent establishment. The definition is very clearly set out within the OECD documents and in the legal text, particularly within the FAQs and the consultation paper. So a permanent establishment will create a tax present for a foreign company if they operate within those boundaries and definitions. The base of tax will apply to all income worldwide for any resident company. Yeah, so a corporate tax will apply on profit related to worldwide income based on the accounting net profit, subject to other certain exemptions and deductible items or limitations. And there is a provision to carry forward tax losses to offset tax liabilities for another group company. So the base is quite clear. There will be a charge on net profit on worldwide income. There are some exemptions. So, for example, there will be no corporate tax liability applied to investment in real estate, salary and employment income, dividends, and interest from bank and savings schemes. Yeah, so corporate tax and the calculation for corporate tax will not include any of those components, right? So those are not within the scope of corporate tax. The rate has been already set, so 0% for taxable income or profit up to 375, and 9% for anything above that. So it is a stepped model. Yeah? The framework as a step model, you will need to distinguish between the profit calculation and the tax liability between 0 and 375 at 0%, and 9% between above 375,000 dirhams profit. The current consultation paper is a little bit silent on the impact on multinationals, because multinationals will have a higher rate of corporate tax, which is under the BEPS Pillar 2 framework at 15%. But there's no discussion, no details related to that in the consultation paper. So it's very difficult to comment on this at this time. From a compliance point of view, the tax will be payable within 9 months from the end of the tax period. So the obligation will be to file and to pay the tax liability after 9 months from the financial year end. Unlike other markets and unlike other jurisdiction, there's no requirement to file any provisional tax filings or advance payments. So it'll be a one-time event and a one-time payment. And there will be non-compliance penalties. What those are exactly will be probably published in the final legislation. That we do not know what those are specifically right now, but if it's akin to what the system looks like on the VAT side, it will have interest penalties, late filing penalties. So it'll be a mixture of fixed and variable penalties. We expect that to be in the final legislation, but those specific parameters are not clear right now. So I'm going to spend a bit of time talking about corporate transfer pricing. Transfer pricing is essentially a model that tries to look at the relationship and the buying and selling of services and goods between related parties. Now, transfer pricing is more about trying to set a commercial arm's length relationship between two related parties. Now, the reason that's there is because unless there are it can distort tax payments between different parties. So transfer pricing will require companies that are connected to set a framework, set a model. It will require disclosure form to the tax authorities that there is a transfer pricing implication between these two connected parties, and the requirement to create a master and local file. Now, what's a master and local file? A master file provides clarity of the relationship and the commercial business model of these relationships between these related companies. So, for example, if you are a company like Majid Al Futtaim, you have many distributors, many subsidiaries, many connections, many companies that are operating under one tax structure. And these companies may buy or sell goods from one another or services from one another. So the central master file provides an overall understanding of how your company operates, its commercial relationships, and the way it is governed in terms of the commercial side. So the master file document creates that understanding for the tax authorities. A local file provides clear evidence and demonstration that you have come up with commercial policies and rules to maintain an arm's length relationship between these companies, and are buying and selling between these companies at commercially viable prices. So there is some justification required to say that what we are selling from company A to company B is equivalent to the pricing that we see in the market at a commercial rate. Yeah, so the tax authorities can then assess whether your policy does maintain an arm's length relationship, and those commercial relationships and pricing terms are no different to that what you may provide to other parties. Yeah, so this is quite important. It brings in the discipline of creating this policy, this documentation for disclosure if required by the tax authorities. It may not be relevant for SMEs, but if you do have 2 companies, 3 companies, 4 companies, and they may operate above a certain amount of income or turnover, then you may be required to create a transfer pricing policy. There is a lot of provision, of course, around tax grouping, and tax grouping will allow you to create a unified tax group. The unity of the tax group creates the ability to join together many companies under one tax group, but there are specific requirements for you to create one tax group. The benefit, of course, is the ability to centralize, combine, and file one corporate tax return, and that allows the simplification in terms of the administration and compliance and reporting, and it allows you to combine losses from one company to another. So there are benefits in tax grouping, and there are benefits in combining the losses between one another and getting the relief. The other element that the corporate tax will bring through are the concept of transfers and restructuring provisions. Basically, if you have losses related to restructuring, and these losses can be offset as part of a group, and then that reduces your tax liabilities. Yeah, and I'll talk a little bit more about that. And the transitioning rules are quite defined. Yeah, so transitioning rules will be set out in the final legislation, but it's very clear, very specific in the current public consultation document that nothing prior to the date of registration for corporate taxes will be eligible in terms of losses. Yeah, so losses incurred prior to the date of corporate tax registration will not be eligible in your corporate tax returns. So they're trying to bring in a very hard line on the date to discount any benefits or reliefs or exemptions that you may be seeking to apply in your corporate tax filings only after the date of your registration. So tax groups. Now tax groups have a more stringent requirement than we have seen on the VAT side. So a tax group can only be created if there is a 95% of the share capital voting right of the subsidiaries. So if you see the description on the right-hand side where all the entities have, by way of shareholding, share capital, and control greater than 95%, that is eligible for tax grouping. It's likely there will be a declaration required and submitted to the FTB to form that tax group. Okay. But there will be limitations. So any exempt or free zone company benefiting from the free zone 0% corporate tax rate will not be eligible. Okay. But there are clearly benefits that it allows the consolidation and the administration to be centralized. So there are some interesting questions that companies will need to look at specifically around tax grouping from the structuring standpoint, and whether the benefit of restructuring multi-companies into one tax group is viable versus the cost of doing so, and what that implies in terms of the minimization or the optimization of the corporate tax payment and liability. So tax groups are an interesting concept for further discussion and further investigation. I think it takes a bit of time to look through that, and in terms of the lead time we have before the formal introduction in 2024, it's probably a good time to really think about, if your company operates many companies, how it is connected in terms of shareholding and capital, to see whether you are eligible to form a tax group and what the benefits are. Okay, now free zones. Free zones are a very special to the UAE economy, and in the consultation paper, there's a fair amount of discussion about what they're trying to do with free zones. One should state that the consultation paper is non-binding. It provides some directional compass on where the tax authority and the Ministry of Finance are leaning towards in terms of the final legislation. Yeah, but there's a lot of discussion in the consultation related to free zones. And free zones in the UAE economy is quite important because the free zones provide significant foreign direct investment. There are a significant number of free zones, and they provide a very good business base from which companies can operate in globally and in the region. So free zones are quite an important element. In terms of free zones, the UAE has provided insight that there will be a zero rate of corporate tax eligible for free zones with conditions. So the free zones must only operate outside of the UAE, or they must operate within the same free zone or with any other free zone. So if we think about the current VAT legislation, it's a very similar concept when we're thinking about designated free zones and the implication of tax on goods between free zones. So it's a very similar concept. The only provision is that there cannot be any business conducted into the UAE to qualify for the zero rate of corporate tax. Now, if you operate a free zone and a mainland company, a free zone can operate with zero rate of corporate tax. The mainland can operate with a 9% rate of corporate tax. Yeah, but the free zones cannot make any deductions for payments made by the mainland. Yeah, so there are restrictions in terms of payments and deductions for payments on free zones. But if you operate a free zone with a mainland group as a branch income, these deductions will also not apply. Okay, so what they said basically is that free zones can benefit from the zero rate of corporate tax, but there are exceptions. Any income apart from passive income coming from mainland companies will be disallowed, and that there will be certain requirements to enable you to benefit from that zero rate of corporate tax. But there is the benefit of filing for the for zero rate of corporate tax. There will be certain provisions there. For example, if you do apply for the exemption, then the exemption can only be applied for at one time, and it cannot be applied for again and again. And once you have made the application, you can benefit for that zero rate. The other impact, most likely, is that there will be a continued requirement for filing, but there may also be a continued requirement to submit audited accounts, to provide evidence and justification to the tax authorities that you're continuing to operate within the confines of the legal and regulatory requirements under the free zone jurisdiction, and that you can disclose enough information to them to know about the way you're conducting your business, that there's no evasion on any of the corporate tax. So there will be additional reporting requirements to continue to benefit from that zero rate of corporate tax. So as I mentioned, yes, you'll need to continue to register and file. There will be a 0% corporate tax returns in terms of compliance. The audited accounts may be required. It's not 100% sure, but I suspect there will be a requirement to maintain audited accounts to claim the benefit. They will not be. They cannot form a 0% rate exempt corporate tax exempt free zone into a tax group. They will be isolated, and they will remain to be isolated. And once again, if it is granted, if the status is granted, it will be permanent. So there's some thought necessary to see whether your free zone will continue to operate with a singular contractual model with clients externally or just within the free zones, because once you make the application, they will expect you to continue to operate on the same basis indefinitely. Now, if there is a likelihood that your free zone will conduct business with other mainland companies, the 9% rate will apply. Yeah? But there is the opportunity, of course, that if your free zone does have a mainland branch, then the income received on the mainland will be subject to 9%, but you could continue to benefit from 0% corporate rate on other income. Yeah. So these are the kind of indications of where the corporate tax regime may land, and the specifics and the mechanics of how to assess that will be much clearer once the final legislation is present. But I think we can see now, certainly from the publications from the Ministry of Finance, that they do want to provide certain benefits and exemptions to continue to give free zones the opportunity to thrive and to provide a basis for continued foreign direct investment, as long as there's no pollution in the income between a free zone and a mainland source. Yeah, that's the main message that the current information that's disclosed by the Ministry of Finance is emphasizing. Some other elements. I'm going to talk a little bit about the importance now of how the deductions and the allowable expenses will work. Yeah? So there are some limitations, and there will be limitations in terms of interest expenses. So certain expenses will have caps. So interest expense will be capped at 30% of EBITDA. Entertainment expenses will be capped at 50%. And other administrative expenses, recoverable VAT, and donations to non-approved expense organizations, these will also be disallowed. So the BEPS framework specifies the mechanism of calculating your corporate tax liability, which is normally the income minus allowances and allowable expenses and allowances and exemptions to get your corporate tax liability. But in the calculation, certain aspects will either be capped or they will be disallowed, in the calculation. Now, a common question is always the question of director salaries, and whether a director salary can be, set at a certain level. And at the moment, the legislation doesn't talk a great deal about this, but it is very likely that there will be a cap on the director salaries, and that there will not be an infinite opportunity to increase director salaries to optimize that tax payment. Yeah, so normal salaries, of course, are normal administrative expenses. These are employees. They have a visa. They are an employee. They're not a shareholder or a director of the company. So those will be allowed as a normal administrative expense. But the director salary is unlikely to be given complete free range. There will be, some clarity in the final legislation to set a cap percentage. Okay. Now, withholding taxes in the UAE have always been set at 0%, and withholding tax is basically a deduction of payment at source to another beneficiary, to a foreign beneficiary. So it's still going to continue, and withholding tax will not be applied within the UAE framework if it's earned by a foreign company, not attributable to a UAE permanent establishment. In other words, a company that has not created a tax presence here in the UAE, or income earned by a free zone person. There will be no withholding tax on that, even if the free zone person is benefiting from zero rate of corporate tax. And there will be no withholding taxes on dividends or profit made by a free zone person. So they will continue to try and emphasize zero rates of withholding taxes, particularly between free zones and foreign entities, if there's clearly no income earned by a UAE permanent establishment. Okay, so withholding tax at 0% is still a major benefit, and it's one of the major is a key factor of trying to reduce deductions at source and payments at source to parties overseas or to free zones. Okay, right. So preparation. I hope during the conversation I've gone through a little bit of a whirlwind in terms of the technicalities and the framework around corporate tax. It gives an indication. Now, important to note is that every company is slightly different. Every company will look at its own structure. It will look at its own contracts, its own model, and will need to look at these elements through some form of impact assessment. So it is ideal to start thinking about these sort of things, to highlight gaps and to look at opportunities. And in terms of management, there will be obviously changes required to chart of account, to look at your internal processes, and to look at the technical aspects. And when I mean technical aspects, I mean the legislation and legal aspects of adhering to the corporate tax framework, and to look at your IT. Now, Zoho Books, of course, is a very flexible system and provides a great deal of ability. And I'm sure that there will be some enhancement to Zoho to help us deal with the generation of a corporate tax return. The point is to think about how the expense lines can be structured in a way to maximize the benefit from exemptions and allowances. So it's time to think about whether you set up your reporting structure in enough detail to allow you to make the process of calculation of corporate taxes and to gain the benefit from all those exemptions as easy as possible and as clear as possible. The other issues, of course, is to think about whether you are going to require some form of transfer pricing policy. Because if you have related parties working with one another within the UAE, there will be possibly a requirement to look at transfer pricing. Once again, I talked a little bit earlier about tax grouping and the benefit of release from tax grouping, the benefits from corporate tax if you're a free zone, but it would be useful to look at the legal structuring. If your entity is purely a free zone and it is providing services to UAE or to companies internationally, would it make sense to structure this so your contracts are split between international and local? Does the cost of setting up that structure outweigh the benefit in terms of compliance reporting and the tax liability to benefit and apply for a zero rate of corporate tax? So structuring and the way you conduct your business within the free zone or with the mainland and the free zone, and how you separate business transactions and how you can manage that, and whether you want to gain the benefits from the provisions under the legislation the UAE has provided to get the maximum exemptions or the benefit of operating purely from a free zone. That's part of looking at whether the legal structure is an important aspect. Of course, the accounting is an extremely important element to simplify and to ensure that you are really thinking about the day-to-day operations to minimize the complexities when you have to calculate your final corporate tax return. So it's very common, we see this a lot within a number of companies we work with, that don't really structure their reporting model to give them enough granularity, right? So the statute of limitations under the corporate tax framework will require data record keeping requirements far higher than the VAT regime. I think it's nearly 7 years. So the accounting becomes more and more important in ensuring the structure is there as on the expense side, the granularity is there, the possibility of looking at which exemptions can be maximized, and to simplify the calculation of the corporate tax return. Yeah. Once you've kind of taken a look at all of these questions, then of course there is the question of coming up with a plan. And at this time, it's probably useful and wise to think about some of the highlights and plan towards those, because it will save you a significant amount of time, and many companies will have a significant job, particularly on the structuring side, to think about whether they're going to implement this prior to the introduction of CT next year. So planning is quite key, and I think if anything, some of the lessons learned on the introduction of VAT side are quite universal, they're quite relevant. The legislation came late, and it came late for I think November 2017 for the introduction in 2018. Companies weren't really well prepared, and therefore they didn't have a lot of planning time to kind of think through and look at their overall model, their processes, their systems, and that led to a lot of consequences in terms of penalties and issues, and not managing their whole organization well. Training was a big part of that, and I think from the implementation side, you should be thinking ahead around the implementation. So thinking about how you're going to structure the record keeping, optimizing the way you're going to operate your accounting and books, and to get the training in place to make sure that people understand specifically how to take care of the calculation and use the system effectively to help them achieve that. Okay. Now we do help quite a lot of companies, and typically what we are doing at this time is we're conducting quite a lot of different corporate tax impact assessments under a corporate tax health check framework. So it takes account for all of that 360 view on systems, people and processes, policies, structuring, contracts. So we're conducting quite a few projects at this time for companies to take a look at optimizing their effective tax rate, either at a small company level with impacts on their business to look at whether a free zone makes sense or not, or at a larger company level where there's more complexity and there's a lacking transfer pricing policy. So we are helping quite a lot of companies think through the implications, particularly to optimize their corporate tax number and to ensure that organization is well prepared and that they have the right processes and training in place to operate a model. So if, for example, you have any you have any detailed questions, by all means, you can reach out to us. We can certainly have a conversation, and we can look at what we may be able to do to help you. Thank you very much. And I think I've covered 43 minutes, so I hope we'll get sufficient time for Q&As.
That was a wonderful session. Thank you, Mr. Haroon Juma. Thank you so much, everybody. Have a great day. Bye bye.